Okay, great, guys. So let's go ahead and get started. And what we want to start off with doing for the benefit of people that were not able to see our initial talk, let's go back over the rules of the strategy. Okay. Rules of the strategy is this. The first thing we look for is the rejection of a higher time frame structure. Okay. The main strategy that we use is the 415, meaning we look for the rejection of 4-hour structure, be it support or resistance. We go to the 15-minute, we look for a simplicity entry arrow. And then that is the place where we take our entry when we have other areas of confluence. Okay, so let's go through that. Rejection of higher time frame structure, simplicity arrow on the local time frame. Notice I'm saying local and not just 15 because this is a strategy that works with multiple time frames. You could do the 1 hour and the 5. You can do the daily and the 1. You can do the 30-minute, the 15, 30-minute, and the 1 minute if you like. Okay. But this is the principle that we want to make sure that you get. So third is we look for the short term and the long term trend surfers to be in the desired, in the color of our desired direction. Meaning, if we have a simplicity arrow pointing down, we should see the short term trend surfer as well as the long term trend surfer red. Red meaning representative of down. Okay. Now the oscillator. Okay, the oscillator, to which was an additional indicator that I gave everyone, it should break the zero line. I mean, there's a line that goes in between it. It should break the zero line into the color matching the desired direction. So in this scenario, if it was bullish, it should break the zero line and you should start seeing red or whatever color you have representative of red or bearish. So it should break the zero line, meaning the breaking of structure, and it should start going down. Okay. In this particular scenario, momentum line for those that have it. Sometimes on some setups I have it, some setups I do not. Okay. It should also be pointing in the same direction. In this case, it should be pointing down. Okay. The algorithmic trend line should be matching in color of the desired direction. So in this scenario, we had a simplicity arrow going down. Short-term and long-term trend surfers are red, meaning going down. The oscillator has broken the zero line going down and being red. The momentum line is going down, as well as the algorithmic trend line should be red in color, meaning that momentum is going down. Okay. And then the last thing, and I had to have a little addendum here, and this same algorithmic trend line, the smiley faces as it's affectionately known as, it has crossed the 50 smooth moving average. Okay. If you do not have that on your setup, we need to get you set up tonight so that we are all looking apples to apples. Okay. Not just a 50 moving average, a 50 smooth moving average in the desired direction, meaning that the algorithmic trend line in this scenario, everything was going down and bearish. We shouldn't see the trend line going up across the 50. It should be going below the 50. Okay. Now I added another thing because I did some additional study and I was looking at what was the difference between, we did have a smiley face trend line cross over to 50, but it went back. I know some of y'all, have y'all seen that happen? Let's put a 2 in the chat if you've seen that happen, where you like everything was there, the trend line crossed over. Okay, see, I'm seeing some 2s. Okay, and it went back. So I started saying, hey, what is it about these that are different? Okay, so I'm about to show you right now. So this is the last piece, and this is the additional thing that I've added to our rules to ensure that we get quality entries. Okay, so I'm gonna stop sharing for a second. I'm gonna pull it up on my desktop. Okay. Share. Desktop. I think this will work. All right, guys, you may see a whole lot of repeat stuff, but can you all see this chart, this picture of a chart that I'm showing you? If you can see that, please type a 1. Okay, great. Thank you. Awesome. Thank y'all. So this right here, I think this GBP JPY. We see arrow come in, we see rejection of structure. It's not quite in alignment, but it gets in alignment right here. As you can see, guys, the big difference in this, do y'all see this huge candle that broke through? Okay. Big candles mean something. Okay. If you want to be technical, it's called an engulfing candle. Okay. And the reason it's called an engulfing, and you all can look, I'll put some diagrams up of an engulfing candle. An engulfing candle means the strength of the candle was such that it engulfed the range of the previous candle. So let's say the previous candle was just this long, the next candle was this long. That indicates volume in the market. Okay. So what I found was, and I'll stop sharing for a second to show you 2 separate cases. Give me 1 second. Okay, here we go. So I'm about to share this with you guys so you can see this. As you can see right here, you technically had a cross right here, but look at the size of this candle. I can't zoom in anymore. I don't think it'll let me zoom in anymore. As you can see, when this crossed, look at this little candle. So it did go up some, but the trend did not hold because these candles indicate the level of volume in the market. Okay. Compare that with this one. Okay. Look at the volume in these candles when the trend line was crossing over the 50 moving average. Okay. Now you can't see this right here, but it came back and touched this line and it kept going up like 180 pips. Okay. So it came down and retested, but this, as you can see right here, it crossed up here and it did not hold. So if you had gotten in right here and had put your stop loss behind this level of structure, you would have made pips if you had gotten out here, but if you had held it, it would have stopped you out. Okay. Versus if you would have gotten in right here, put your stop loss behind this level of structure, it may have gotten close, but it did not, you did not get out. Okay. If you had put it underneath the crossing, you would not have been in danger of getting stopped out. Okay. And so that's the reason. And now essentially, guys, what this is reading price action. Okay. And I want to make sure that everybody can read at least basic price action. Okay. This engulfing candle meaning there is a load of volume in the market. And as you can see, it continued. Okay. When candles get short, that means that a trend is getting weak. That means there's reducing volume in that particular direction. And so then a lot of times it will change. That's an indication that the market is about to change the direction because the candles start getting shorter. Okay. So we're not going to get too deep tonight, but I did want to add that to our list. Okay. So just to review one more time, we want the trend line that has crossed the 50 moving average with a closed candle, okay, with volume. And I cannot stress this enough, guys. I don't know about you, but I have gotten in moves where it looked like, man, the candle just, I mean, that candle was just driving like a train. And so I jump in, man, I'm getting in this move. It's going. And this is what you call chasing a trade. Only to find that within the last 30 seconds of that candle, that joker does a U-turn and goes, woo. Anybody ever happen to that? Put a 3 in the chat. Then you say, man, this thing is pushing down, it's pushing down. Let me tell you, a break of structure or a breakout is not official until the candle closes. Okay? And so we don't want to just jump in when we see the moving average cross over the 50. We want to see it cross over the 50 smooth moving average with a closed candle. And that candle needs to have significant volume in it. Okay? And I want you guys to back test it yourself. Every time where it crossed and there was not significant, it was a weak, small candle, 90% of the time it reverses and goes back. It doesn't hold. But also 90% on the other side, when it crosses with volume with a healthy sized candle, it usually continues. It may come back and retest, but that trend usually continues. Okay. So that's just one little extra level we want to put in. And it's good to even start looking at candles and start reading price action. Okay. For the sake of time, you all know that that's posted our personal checklist. Okay. Last week, we went over risk management rules. Okay. Guys, we are risking no more than 1%. Okay. If you risk 1% on every trade, you can lose 99 more trades before your account is gone. Okay. But if you lose 99 trades, you may want to consider another endeavor. Trading is probably not for you. Okay. But a maximum of 1% account on 1% of your account balance on any single trade. Okay. Also, no more than 3% of your account balance can be at risk cumulatively at one time. Example, if I was in GU, I'm risking 1%, Euro NZD 1%, CAD JPY 1% equals 3% risk. Okay. Or you can break that down amongst 6 trades that you're trading 0.5%, whatever way you do it, whatever way floats your boat. That doesn't, whatever way you divvy that up, but we want to limit our exposure. Okay. All right. Look, how to determine our lot size. First, we want to determine our percentage of risk. That percentage of risk is 1%, right? Then next, we go into our charts and we determine our stop loss. Okay. Next, we then determine our take profit, and then we enter that data into the risk management calculator. The one that I use is Nash Markets. I think it works great. If you found a number that works for you, please feel free. But enter all that data into the risk management calculator, and then the calculator will give you a lot size based on the information you put in. Now, garbage in, garbage out. If you don't put the right information in, it's not going to give you the right lot size. Okay. Then once you enter the trade with the lot size given by the risk management calculator, then you make sure we don't take trades unless they are at least 2-to-1 risk to reward. Okay. I know that is kind of contrary to what Super Easy teaches. The reason they go for 1-to-1 is because their stop losses are so big, because they're putting the stop loss above the box, above the sell zone or buy zone. That is not wrong. That is just a way to trade. The way that we trade when all these other areas of confluence. We wait later, but we wait. Our objective is to get in when price is breaking out of a structure with momentum. Okay, guys. And when we do that, we can get shorter stop losses. Shorter stop losses allow us to get larger lot sizes. Larger lot sizes mean that we can allow the trade to move a shorter distance with a larger lot size, meaning it will pay us bigger without having a lot of exposure to the market. Okay, so that's the whole theory of it. We talked about last week why risk to reward matters. If you trade only 1-to-1, you have to win 50% of your trades to break even. If you simply raise that to 2-to-1, you only have to win 33% of your trades to break even, guys, meaning you can lose 77%. You can lose over 7 out of 10 trades and still break even. Okay. If you raise that to 1-to-3, you can lose 75% of your trades and still be at break even. Okay. Now, we don't want to be losing that much, of course, right? But it takes the pressure off of having to try to win all the time. And when we don't want to, when we, I used to be like this, that I was afraid of feeling lost. And as a result, when I was afraid to feel lost, I held on to trades too longer than I had to, because I was trying to avoid the feeling of loss. Okay. When I could have just took my 1% loss and lived to trade another day. Okay. So our new material tonight we're going to cover, guys, is trade management. Okay. Trade management. So it's one thing to do risk management, and people always, limit your losses, cut your losses short, let your runners run, blah, blah, blah. Okay. But what about when you have a successful trade? No one ever really teaches how to successfully manage successful trades. Okay. We're in this to make money. We're in this to invest this and to glean this out of it. Okay. And so we have to have successful trade management. So trade management is defined, as I define it, is the ability to minimize loss and maximize profit. Okay. So we want to minimize our losses and maximize our profit. That is proper risk management and trade management. Okay. So there are two types of management. Okay. And this stuff will be posted, but if you need to write some notes that make sense to you, please do it. Okay. There is passive management and there is active management. Okay. Both of them start off the same. Passive management is this. We get a stop loss set, we get our take profit set, we use proper lot size, and we wait for the result. Okay. That everybody's done that, right? This is my stop loss, this is my take profit. I'm gonna let the trade play out. Okay. There is nothing wrong with that. There are times when I'm not able to be at my computer and manage it, that, hey, I'm just going to live with the results. Okay. Then there is active management. Okay. It starts off the same way. Stop loss set, TP set, proper lot size. But now here's the difference. I dynamically manage my profit or my drawdown. How do I do that? I do that by scaling in and out of the trade to bank profit or to mitigate loss. I'm going to repeat this, guys, because this is very, very important. Okay. Both of these are the same until it gets here. We're going to dynamically manage our profit or our drawdown by scaling in and scaling out of a trade to bank our profit or to mitigate our loss. Okay. So let me show you an example of what I mean by this. Okay. Let me share. Hold on. All right. All right. Can you all see that? Uh-oh. I will go to another one. I'm letting a little cat out the bag a little bit. Hold on one second. All right, great. This is Euro Swiss. Okay, this is Euro Swiss. This happened today. And there's something I want to share with you guys about this as well. This happened today. We see the arrow. All right. First of all, we see this. We see this is the original arrow that came in. It wasn't ready, right? The 4 hour, the daily is backing this up. We didn't really get it. We never got a real clean break. Nothing ever really matched up. And so we wouldn't, you could have gotten in right here a little bit. It gave you something, but it didn't give you a lot. Okay. As you can see right here, guys, I want to show y'all an example. I want you to see the reason why this thing went back. Zoom in one more level. As you can see, this thing crossed here. Y'all see that? But at the point of the cross, look at the candle that it crossed on. See how weak this candle is? It crossed with a weak candle and it did not hold. It went up a little bit and came down. Versus, look at it when this bad boy passed. It crossed with a huge candle and it just went to the moon, right? So I just want to show y'all that example. That's what I mean by crossing with volume, right? But so this is the opportunity right here. We saw it go, it went up here. This thing went into immediate profit. Okay, guys. Our stop loss would have been here. Let's say 10 pips. Immediately, it went to 34 pips. That's a 3-to-1 trade right there, guys. Okay, so if you risk $200 on this trade over those 10 pips, you immediately made $600 right there. Okay, but this is what I mean. I know there's more run in this. You know why? The reason I know there's more run in this because not only is the 4-hour pushing this way, but so is the daily, guys. Okay, so as a result of that, I know that there is a strong push that's going to be in this move. Okay, so here's what I'm going to do. I've been guilty of this. I've been guilty of like, oh boy, I've got $1 lot on this. I want to run this joker all the way up here. If I got $1 lot and it goes all the way up here, that's 80 pips. This thing is going to go. I'm just going to get $800. Easy. Let me bank that. Versus, hold on one second. Versus doing it this way. How about, let's say I want to risk $200 so I can, okay, 10, I put in the calculator and say my stop loss is 10 pips. Well, they said, well, if you're risking $200, you can actually do a $2 lot. Okay, $2 lot is like $20 a pip. All right. Here's what we would do. We would take this first impulse. If y'all remember this, last week I talked about when a bullet is first shot out of a gun, that is when it is at its most velocity. If y'all remember that, put a 5 in the chat. Okay, y'all remember that? All right. So we talked about last week that when a bullet is, that's the reason shooting somebody point blank does so much damage, because that is maximum velocity. That's the reason a person will saw off a shotgun, because it gives maximum velocity. So here's what I'm talking about when we manage the trade. We had a successful trade. I've done this before. Man, I'm gonna hold this thing all the way up to here, and then it starts going back and I panic. I get out of the whole thing because I was up 600. Now I'm only up 350. And now I'm beating myself up. Okay. Here's what we want to do. Whenever we have a successful trade, this is only a suggestion, but this is what I do. We have a successful trade. We want to trade this impulse. This is the highest velocity moment of this trade. The rest of this trend, it moves steadily, but it moved with more direction and more velocity during this period. Okay. Here's what we do. When I get to this point, when I feel like it's hit an arc or a crest, I think it kind of hit with this level here. What I do, I close 80% of my position. So I want y'all to type that down, 80%. I close 80% of my position. I move my stop loss to break even, and I let the 20% run. Okay, you're like, well, that don't sound like much. You know, if I had $1 lot, I mean, I closed 80 cents of that $1 lot, and I let 20 cent run. Well, 20 cent is $2 a pip. Let's just pretend it's the GU. You know, it's $2 a pip. Well, this is my original thing right here, right? Well, $2 a pip that ran up here to the top, let's just round up, say 80 pips, still yielded me $160. Okay, so let's say, I closed 80% of it, and I got about $300 here, $360 here. I closed 80% of that. I let the rest run. This may have taken 2 or 3 more days, but guess what, guys? Now I've turned a short intraday trade into a longer swing trade. Okay, now I'm changing it into a swing trade. The problem I have with swing trading is I could not hold large lot sizes for that long term. But if I've already eaten good here, I can leave the rest to run, and I'm not worrying about it. If y'all understand that, put a 7 in the chat. Okay. Only see 2 sevens. Let's see 3 sevens, 4 sevens, 5 sevens. Okay, good, good, good. Okay, so I'm going to review that again, guys. We have a successful trade. We want to take the first impulse, and that's the one we want to have our heaviest lot size, and we want to take some off of it, leave 20% to run. Here's the beauty of it, guys. We can find these 415 setups every day. So let's say, Monday, this is the one we found. And so we're letting that run. It might run until Thursday. Well, then the next day we find one, great setup. And I'm just, let's just say this is the setup we found. This is Euro AUD. Okay. This one, the impulse wasn't as clean, but let's say we hold it down to here. And let's say, our stop was above this level, 36 pips. Let's say this thing allowed us to get another $1 lot. Okay. Well, the first impulse, it may have took a while, but when it reached that real bottom after that consolidation, the thing ran 106 pips. If you got a $1 lot, guys, I think Euro AUD pays 9. Somebody put it in there. I can't remember off memory. I think Euro AUD might pay $7 and something a pip. You're talking about $700 just for this move here. Okay. Peel off 80% of that. Why? Because I've got confidence. The 4-hour and the daily are going down. Okay. If I left my 20 cent of that $1 in there, did it go back some? Yeah, it went back some. But I got in such a great position. I'm not tripping. Right? But look how far it goes down, guys. If you hold that 20 cent all the way till it reaches the other arrow, that's 190 pips. So now I got 20 cents. Okay, representative of that's 70 cents, like $1.40. I think a dollar, $1.40 per pip that you probably are getting, or close to $2 a pip, running that course for 190 pips. Now, keep in mind that is running concurrently with my Euro CHF. Okay, so not only have I eaten well off 2 trades, Now I have two smaller portions running concurrently together. Okay. And then you can stack and find another one. Let's find, let's, let's pretend right here, this is GU we found. Okay. It meandered around, and we finally caught this fall, this drop here. Okay, when it crossed. Let's say 20 pips, and it went 54. That's almost a 3-to-1 trade right there, guys. Okay, that's the impulse here. All right, we had $1 lot. We would take 80% of that $530 there. Let the rest run. Okay, because I think y'all seen now the system is proven it goes from arrow to arrow. This is the 4 hour. It goes from arrow to arrow. So if I get in right here, let me eat now and let the rest run. So now I got 3 trades that I've eaten well off of. I've probably gleaned or gained maybe $3,500, $3,800 just off impulses. In addition to that, I left 20% of my lot size run until the end of the run. Okay. Now we've got 3 trades. One might have run for $180. The other one may have run for $200. The other one may have run for $100. But you add those up. Now you've eaten at the beginning and you feasted at the end, but now you've compounded all your successful trades. And so at the end of the week, you could just collect all these small ones that ran long, but you have multiple ones that have run long, along with the fact that you've already eaten well at the beginning of the week. Okay. If that makes sense, guys, give me a 9 in the chat. Awesome. Awesome. Does that sound like something you all would want to use? And let me eat it. Let me eat a little now. Save my dessert for end of the week. Okay. What I'm trying to do, guys, is us to maximize. If we can maximize our lot size, then we can ride these impulses. We can eat for the day. And I don't know, when we get together and we'll talk about what your measure is for your how much you want to make a day. Is it is it 200 a day? Is it 350 a day? And so that's part of our trading plan. We're going to be developing. What is your marker for what you want to make for the day? Okay, because I tell people, fall out of love. I used to be obsessed with seeing people that got 100 pip trades, 180 pip trades, 230. I like, man, that's insane. And I used to chase after that until the day that I realized it's not the length of the run, it's the amount of lot size on the run that you made. Okay. I know people who scalp who put, $40 lots and only, which is like $400 a pip. And all they needed to run is 10 pips. So never feel bad or diminish your 10 pip run, your 15 pip when somebody's getting 80 and 90. Reason being is it doesn't matter how long the pip run is. It matters the lot size on the pips. Okay. When you start thinking like that, my first job is to be a master at catching pips. Once I learn to master catching pips, all I have to do is increase my lot size and game is over, guys. Okay. So let's not focus on money. Y'all may see my lovely wife in the background. And I want us to share our successes, but guess what, guys? I don't want us sharing profit. Let's share pips. Okay. because one man's pips could be worth 1,000, another person's pips. Yes, you do need a yes. Very large lot size. The person I want, they have a very large, very large account for 40. Yes. Um, I want us to start sharing the pips that we catch, okay? Because that's the thing that matters in the end. Our job and our quest is to catch the most amount of pips, the safest and the fastest we can in the market before it starts doing all the jittering around, okay? And then when we have smaller lot sizes that are running the duration from one end of the arrows to the other, we can take advantage of the whole 4-hour move without being as emotionally attached to the trade. Because what makes you so emotionally attached to the trade is the amount of money you have invested in it. If you have already eaten off of that trade, and then you just leave a little bit to run, you're not as emotionally invested. Okay, so that's how we actively trade. Okay, it takes getting used to, but I tell you, it's something that will work as you can continue to compound and build that. Okay, now let's talk about the other way. Now this will be much quicker. Let's say you get into, let's look at the charts here. Okay, this evidence dot right here. This was an evidence dot that said to buy. It's green. Okay, now we wouldn't have taken this because it was going against the 4, but for the sake of conversation, let's talk about this. This was a simplicity arrow that was going up. Okay, went into some profit. We probably would have put stop loss probably right here. Okay. Be honest with you, I wouldn't have taken this at all, but I'm just trying to do it for the sake of. I'm just gonna put another. But we would have put it underneath the crossing, right there. Okay. Upon getting in, as we can see, it starts going against. It goes in a good profit, but we start seeing. I'm gonna zoom in. We start seeing, like I told you guys, we start seeing weak candles. Y'all see these little short candles? That's an indication that a trend is losing steam. And now slowly we start seeing reversal. Okay. So the best thing to do in this scenario, guys, is to manage your profit by one, moving your stop loss at break even. If you start seeing something like this, what I need you to do is I need you to close half of your position when you start seeing reversing on you. There's a chance it still could keep going, but I need you to at least close half of your position so that you can bank some profit. Okay. And if you see something like this where it breaks this trend line, then I need you to close the whole thing. All right. That is active management. What we want to do, we want to preserve our profit as much as possible, and we want to mitigate our loss. Now let's talk about to the loss side. Okay. Once this thing broke this way, let's say I got in right here. Once this thing broke, really, to be honest with you, once price broke it first, I would have closed half. Okay, but once it started going down here, I'm closing the remainder of my trade. Okay, this would have been my stop loss. At the minute it broke here, I would have closed the remaining trade. Okay, so this leads me to my last statement here. I want to share with you guys. Hold on. The goal is to risk 1%, but never take a 1% hit. I don't want that to mess with you guys' head. But if you get into a trade, say, hey, I'm willing to risk 1%. But a lot of times, guys, we know very quickly whether we're in a bad trade or not. Okay. And this is where it is going to put on you, put the responsibility on you guys to start studying price action a little bit. Because if we start seeing, if let's say we're in a bearish position to sell, but we see an engulfing bullish candle, and it looks like it just broke another level of structure going the other way, we turn from our analysis that we start hoping, oh, it's going to turn around. Anybody ever been there? Put a 6 in the chat. You start hoping. And I heard a person say, and I'm not going to steal it, but it's been attributed. So I can't know who to attribute to. But a person I heard say that hope is not a strategy, and we're trading according to strategy. And everybody has been in a trade before where you've crossed over from what you analyzed to then we start hoping. We start telling ourselves things. And if you look at the candles will tell you, hey, man, this is going the other way. If it starts going the other way, if you see some signs, close half of your trade. Okay. And then if it gives another sign, it breaks another level or crosses back of price, crosses back over a trend line that it was going that way and it goes the other way, close the rest of it. You will find that your 1% losses, which is very conservative already, will turn into 1/3% loss, or a third or 0.5% loss, or 1/4 or 3/4% loss. Now, I had to get over this because my ego said, man, I don't want to take these losses. It's gonna make my win-loss ratio go down. Anybody ever thought that? Put a 4 in the chat if you ever thought that. I want an 80% win rate. You know, you ever been talking to me, hey man, what's your win percentage? What's your win rate? We already showed you here, guys. Win rate is overrated. It's the ratio that you're winning at when you win. Okay, so if we know we're in a bad trade, why stay in it till it hits your 1%? Why do it? It makes no sense to me. If you know it's a bad trade, well, I'm just going to see what happens. Hope is not a strategy, guys. We're not spectators. We are traders. Okay. So the goal is to risk 1%, but never to take the 1% hit. Now, do I want you guns, shell shock, gun shy, and anytime something go the other way? No, I don't want you closing the trade, but I do want you to be able to look and see that when something is clearly not jiving with what you thought, take your money. Our first job is to preserve our capital. Our second aim is to make money from that capital. If you don't have your capital to maintain, you can't trade. Okay, you have to have capital in order to be in this market. So when you do this, now all of a sudden, now here's what happens sometimes. Sometimes you'll close half of your position, and it will turn around and keep going. Okay. So you can do one or two things. When it gets back in positive territory and you get comfortable, you can add that half position back on. Or you can let that half position just run the length of it, cover that little bit of loss, and keep going. The choice is yours. You are the manager of your account and your trade, but you have to be able to do that. Okay. And so this is a statement here. I want you all to remember that we want to be wrong quick. If I'm wrong about this trade, I want to know quickly so I can get out of it. But I want to be right long. A lot of times we trade the other way around. We'll get out of our profitable trades quickly, but we'll stay in a bad trade, hoping and praying. Got rosary beads in our hands, and saying Hail Marys and everything, hoping this thing turns around, right? No, we don't want to do that, guys. Flip it around. If we're going to be wrong, nothing's wrong with being wrong, because we've proven here statistically If I take a 1 or 2 trade, I only have to be right 33% of the time to preserve my capital. Okay. When you accept this, then it takes the sting out of taking losses because I'm in control of my losses. You want the market be in control of your loss, or you want to be in control of your loss? You need to be in control of your losses. You need to take the calculated risk and know and be honest about it. Don't be so in love with a trade that it obscures your view. Everybody's being in love to where people told you about a person like, no, she's not good. No, he's not good for you. And you arguing with your family because you're so in love with it. You can't see the obvious. We can't be so in love with trades and currency pairs and what we think it's going to do that we don't see what's happening in front of our eyes. And sometimes, guys, there are trades that are just not, sometimes it's the right trade at the wrong time. And it's just not ready yet. Okay. I've been looking at GJ all day today. Everything about GJ from last night till this morning said that it was ready to drop. It went nowhere today. I guarantee you between night and tomorrow, it's going to move and it's going to drop. The setup looked sweet, but it wasn't ready to go. And sometimes you need to call it is what it is, cut your losses and wait for it, wait for another opportunity. Okay. All right. So that's pretty much everything I want to share with you guys tonight. Okay. Now, the other thing is I want to share with you guys, and I'm going to have to get going. But I'll switch over for Q&A. It's one thing I kind of let the cat out of the bag a little bit, but I want to share with you guys something that I'm going to drop in the chat tonight for you guys. And I think this is something that is going to give us some extra level of clarity. I'm going to go back to this same Euro Swiss. I think that was a beautiful trade today. Did anybody take part in that? So let me share this with you. All right. As you can see, there is something different on this screen. Okay. And some of y'all probably saw it at first. We have a dynamic color changing trend line. Now, I will tell you this. This is still 50 smoothed moving average. Okay. Nothing has changed. It's the same 50 smooth moving average. Just to show you guys proof, I'm going to go in. I'm going to go up here. I'm going to hit moving average. I'm going to put 50 smooth and watch. You'll see it put right over it. Y'all see it? That's just for those that may have doubted. It is a 50 smooth moving average, okay? But the great thing about this one is, guys, this one is dynamic in that it shows you the bias of the time frame that you tell it to. Okay, so this one I told it want the time frame set to 4 hours. So basically it is telling me the bias of the 4 hour. Look at this. It's green. And look. And this is what's so neat about it, guys. If you look here, it changed exactly when the arrow came in. So from this point on, we know that the 4 hour is bearish. I may not have a lot of great movement yet. What I'm waiting for is the lower time frame to match up with it. But when I got in, even if it pulled back, I had confidence to stay in the trade because the larger time frame says that it's going up. And guess what? I would have known to get out. And I know now that the trend is over and it's time for it to reverse, because now I see a red, the same 50 moving average. It's kind of salmon pink, but it's red. So y'all just answer this question for me. is this a good point to get in a buy, knowing that this is red? Yes or no? Let me see. We got no. Okay, great. Great, correct answer. Reason being that at this point, I'm going against the 4 hour. Well, we already knew that by seeing this, but this gives extra confirmation. So now, even if I feel a pullback coming, I've got confidence that the 4 hour is still backing me up. Even though I see this price move down, I know it's just a pullback. Okay. And you can see this on any time frame. I can go to the 5 minute. And guess what, guys? It's going to show me the same bias of the 4. Okay. Did it still move down right here? Yeah, it still moved down. But it's giving you at least the information to know that if you're going to take this, you need to take this quickly, because it's not going to last long, because eventually the 4 hour is going to win out on this battle and it's going to go up. Okay, so this is an extra tidbit of information. And this, look at this 5 minute move, guys. When in this 50 moving average still is a 50, it's just dynamic in that it gives color. Look, it crossed here, look at, and it never went back. Okay. So do y'all find that helpful? Would that help you to decipher and make good decisions in your trades? Hey, Dwayne, I got you, man. I'm about to drop it. If y'all give me till after I get my son to get back, I'm going to drop it in. Hold on. Let me see if I can do it now. Give me 1 second. Give me 1 second, guys. Here's what I'm going to do. I'm going to drop it in the chat, and I have a YouTube video that's private. Nobody else can see it. So please, guys, don't share it outside the group. I've got a YouTube that explains it, how to install it. I just dropped it in, and I'll see if I can pin it to the top. Okay, so I'm going to pin it. I just pinned it to the top, and I'll drop the video in. Give me 1 second so I can get the video. Give me 1 second, guys. Clipboard. Okay, and I just dropped the video on how to do the installation. Okay. All right. So guys, was tonight helpful? Did you glean anything from tonight?